Welcome back to the deep dive. So today we're looking at a document that I think most people would just scroll right past without a second glance.
Yeah, it's not exactly a viral news story, is it?
Not at all. It is the fourth quarter and full year 2025 earnings report for the Whirlpool Corporation, which just came out this morning, Wednesday, January 28th, 2026.
Right.
Now, I know what you're thinking. Why on earth are we doing a deep dive on washing machines and refrigerators?
It's a fair question. On the surface, it sounds incredibly dry.
Yeah.
But you have to shift your perspective a bit. Think of Whirlpool not just as a manufacturer, but as a massive blinking dashboard for the American economy.
Because they're everywhere.
Exactly. They are the proxy for the American home. If you want to know what's actually happening with inflation, not the government numbers, but the real cost of goods, or if you want to know if people are actually moving into new houses, you look at Whirlpool.
The canary in the coal mine for the housing market.
And for global trade, yeah.
And looking at this specific report, that canary has had a very wild year. We're not just looking at a spreadsheet here. This is a survival story. We've got the press release, the financial tables, and the executive quotes from Benton Harbor, Michigan.
Right.
And our mission today is really to decode how this manufacturing giant pulled off what looks like a magic trick, turning a massive loss in 2024 through to a profit in 2025.
And doing it while navigating a minefield of tariffs and, a frozen housing market. It's a classic turnaround story. But when you look closely at the numbers, they didn't do it the easy way.
No.
They didn't do it by selling more blenders. They did it by surgically altering the company itself.
So let's get into the numbers, because the headline swing is honestly shocking. If we look back at the full year of 2024, Whirlpool posted a GAAP net loss of $323 million.
A third of $1 billion in the red. I mean, it was a disaster.
It was. By almost any metric, 2024 is a year they'd want to forget. But then we look at the release from this morning for the full year 2025, and they're reporting GAAP net earnings of $318 million.
It's a huge swing.
They basically dug themselves out of a $300 million hole and built a $300 million hill. That's a $600 million swing in profitability.
And just so you know, when we say GAAP, that's generally accepted accounting principles. This is the real number.
This is the bottom line, not some massaged adjusted number.
Right.
So the obvious assumption is that sales must have exploded, right?
Yeah.
Did everyone in America just decide to buy a new dryer in 2025?
You'd think so, but the data actually says the opposite. Sales were down.
Down.
Not by a huge amount, but they certainly didn't grow. So this wasn't a revenue story. They didn't make more money by selling more stuff.
They made money by ruthlessly cutting what they spend.
That's it. The report calls it structural cost takeout.
Which is just a polite corporate euphemism.
It is. It means we became much smaller and leaner. They executed $200 million in net cost removals in 2025 alone.
$200 million. That is a lot of belt tightening.
It is huge. And the CEO, Mark Bitzer, was very specific about why they had to do this. He didn't just say for efficiency. He pointed directly at the volatile macro environment.
Okay.
But more specifically, he linked these cuts to mitigating the impact of tariffs.
Ah, that's the key connection for me. You hear about tariffs on the news, taxes on steel, aluminum, components, but you rarely see the direct equation on a balance sheet like this.
Well, here it is. Whirlpool is effectively telling us our tax bill for importing materials went up, so we had to cut $200 million internally just to break even.
So they didn't even pocket that $200 million as extra profit.
Not at all. They used it to pay the tariff bill. It was a purely defensive move.
They ran faster just to stay in the same place.
Precisely. Although, to give them credit, they did try to play some offense. The report mentions a record level of new product launches in North America, and they claim this helped them gain some market share in the second half of the year. So the strategy was, cut costs in the background to pay for the tariffs, but put shiny new products on the sales floor to try and grab whatever customers are actually out there.
Let's talk about those customers, because when we drill down into the regions, the story gets complicated. We have to look at North America major domestic appliances, MDA.
They're the core business.
Yeah, this is your washers, dryers, fridges in the US and Canada, the engine room of the company. And the engine is sputtering. Sales decreased about 0.9%. They blame volume decline and price mix issues, mostly in Canada.
Right.
But the number that really jumped out at me was the profitability drop. The EBIT earnings before interest and taxes, it fell off a cliff in the fourth quarter.
Oh, yeah.
In Q4 2024, they made $173 million in this segment. In Q4 2025, only 71 million.
That is a massive deterioration. You're
Yeah.
talking about more than a 50% drop in profit during the holiday quarter.
So what happened?
It's a margin squeeze. And there's this one very specific sentence in the press release that explains it perfectly if you know how to read between the lines.
Okay.
They say the promotional environment has not yet reflected the full impact of tariffs.
All right, let's translate that. Promotional environment, that's just sales, right? The President's Day sale, Black Friday, 20% off.
Correct. But remember, the manufacturer Whirlpool often funds those discounts to move volume. What they're saying here is our costs to make the fridge went up because of tariffs. But the market, the stores, the consumers, they still expect those 20% discounts. So right now, we are eating that difference.
So there's a lag. The cost to make the product spiked, but the price tag at the store hasn't caught up yet.
Exactly. They are absorbing the blow to keep the inventory moving. But that sentence, it's also a warning.
How so?
Because companies don't like losing $100 million in profit. They're signaling that this promotional environment is unsustainable. They're telling us, we paid for your discount this quarter, but we can't do it next quarter.
It suggests that prices are going to have to rise.
Or those big sales events are going to get a lot less exciting.
Okay, that lines up with their outlook, which we'll get to. But first, if North America is squeezed, Latin America looks like it's getting battered. Sales down 4.6%.
Yeah, it's a rough scene down south. They're dealing with two different headaches. In Argentina, they cite a negative macro environment.
Which is putting it mildly.
Right. Argentina's been dealing with currency devaluation, hyperinflation.
Yeah.
If you're Whirlpool, how do you even price a washing machine when the currency's value changes every week?
It's a nightmare. And Brazil.
Brazil is a different beast. There, they mention aggressive competition. That implies a price war.
So other companies are just slashing prices.
Likely aggressive Asian manufacturers, yeah. They're slashing prices to grab market share, and Whirlpool is being forced to react, which just crushes their bottom line.
So big appliances are struggling everywhere. North America has tariffs. Latin America has inflation and price wars. It sounds pretty bleak.
It does.
But then I found this one weird bright spot in the report. It's almost like looking at a different company entirely.
You're looking at SDA Global.
Small domestic appliances. We're talking KitchenAid stand mixers, blenders, espresso machines.
The countertop jewels. While the big metal boxes are struggling, this segment saw sales increase by 8.0%, excluding currency. That's very healthy growth.
This is fascinating consumer psychology to me. Why is someone refusing to buy a new refrigerator, but they're happily dropping $400 or $500 on a stand mixer?
It's an economist sometimes called the lipstick effect, but for the home. When people feel uncertain about the economy, or when they can't afford the big ticket item like a new house, they don't stop spending entirely.
They just shift their spending.
Exactly. They shift to affordable luxuries.
So I can't afford the $500,000 mortgage, and I'm not renovating the kitchen, but I can afford the best coffee maker on the market.
Precisely. It satisfies the urge to upgrade your lifestyle without that massive financial commitment. It's a consolation prize.
And for Whirlpool, it's a lifeline.
A huge one. The report notes that their direct-to-consumer business grew significantly here. People are buying these mixers straight from the KitchenAid website.
Which is great for them because they cut out the middleman. They keep all the margin.
Right. It's the one part of the business that's working exactly as intended.
Okay, so operationally, we have a mix of tariff battles and mixer sales. But the biggest news in this report, and the part that I think requires the most unpacking, is the financial engineering they did in 2025.
Ah, yes.
Specifically, the deal in India. They call it deconsolidation.
This is a huge strategic shift. For decades, Whirlpool of India was a subsidiary. It was fully integrated into the empire. But in 2025, they sold off a significant chunk of their stake, reducing their ownership to about 40%.
Now, deconsolidation is a pretty technical accounting term. Can you break down what that actually means for the business? It's not just that they own less of it, is it?
No, it changes the fundamental way the books are kept. When you own more than 50% of a company, you consolidate it. Their revenue's your revenue, their debt's your debt. You control it.
Okay.
When you drop below that majority threshold, you deconsolidate. As of December 31st, 2025, the MDA Asia segment literally disappeared from Whirlpool's operating
Well,
segment.
it's just gone.
It's gone. Now, they still own 40%, so they get a share of the profits, but they don't run it day to day, and they don't count the full revenue on their top line.
But India is widely considered the next massive growth market for for everything, including appliances.
Right.
Why would they sell down their stake now? Why step back from a growth engine?
One word, cash. They needed the liquidity. By selling that stake, they generated a massive pile of immediate cash.
And this connects directly to the other major theme, debt reduction.
We see that with the new CFO, Roxanne Warner. Her commentary is laser-focused on this. She talks about managing significant working capital challenges and prioritizing paying down debt.
Right, working capital, that's the cash tied up in the business.
Exactly.
Ugh.
Inventory sitting in warehouses,
Yeah.
money owed by customers. When supply chains get messy, that balloons and sucks up all your cash. Warner's coming in to clean house. The report says they plan to pay down another $400 million in debt in 2026.
It really feels like they are shrinking the company to save it. They're smaller without the full India revenue. They're cutting costs. They're paying off loans. It's a defensive crouch.
It is. But high debt is toxic in a high interest rate environment. By clearing the balance sheet, they're buying themselves freedom. They're trading potential future control in India for immediate safety today.
A calculated risk.
The necessary one, I think.
Speaking of calculated risks and value, I want to talk about this section of these reports that I always find a bit melancholy, the impairment of goodwill.
The graveyard of brand value.
It really is. In 2024, they took a huge hit, $381 million down the value of the Maytag trademark. And now, in this 2025 report, we see another one, a $106 million impairment charge for Genair.
And this is significant. To explain goodwill, when you buy a brand, you often pay more than the value of the factories and inventory. You're paying for the name.
You're paying for the fact that people trust Maytag.
Exactly. And that extra value sits on the balance sheet as an asset.
So when they impair it, they are essentially saying, oops, we were wrong. The name isn't worth that much anymore.
Correct. They're admitting the brand equity has evaporated. And look at the names, Maytag and Genair. These are legendary American brands. Maytag was the symbol of reliability. Genair was luxury cooking.
So the fact they're writing down nearly $500 million of value on these names in 2 years.
It tells you everything you need to know about the modern market.
It tells me that the 30-year-old home buyer today doesn't care about the Maytag repairman.
They really don't. The heritage premium is gone. Today, a consumer walks into a store and sees a Samsung or an LG fridge. It has Wi-Fi, it has a touchscreen, it looks sleek, and it's often cheaper.
The competition from the Asian tech giants has just eroded the value.
Completely. Whirlpool is acknowledging that they can't just slap a Maytag badge on a metal box and charge a premium anymore. They have to compete on features and price.
It's a painful admission. So, to recap where we have a company that is fighting tariffs, shedding assets in India to pay debt, and admitting that its legacy brands are losing value. If you stopped reading there, you would think this company is in deep trouble.
It sounds like a grueling rebuilding year.
But then you get to the 2026 outlook, and suddenly the clouds part. CEO Mark Bitzer sounds incredibly confident about the year ahead. It's almost jarring.
It's a stark contrast to the backward-looking numbers, isn't it? He's projecting a very strong 2026.
He is, and he cites two main reasons: reduced promotional intensity, and this is the big one, a gradual recovery of the housing market.
Okay, let's go back to reduced promotional intensity. This confirms what we suspected earlier, right?
Explicitly, they are planning to discount less. They're going to protect their margins by holding firm on price.
So, for you listening, if you've been waiting for a sale to replace your washer, that window might be closing.
Yeah. But the bigger gamble, the one that really underpins this entire forecast, is the housing market. Bitzer is betting the farm on a recovery.
This is the $15 billion bet. The appliance industry is inextricably linked to housing turnover. People buy appliances for two reasons. Replacement? My dishwasher broke. And discretionary, I'm moving or I'm renovating.
And the real profit is in the discretionary spending.
Absolutely. And that only happens when people buy houses.
And since interest rates have been high, the housing market has been locked up. Nobody's moving.
Right. Whirlpool's guidance for 2026 assumes that lock is finally going to break. They're forecasting sales of $15.3 to $15.6 billion. That's about 5% growth.
But look at the earnings projection. They expect earnings per share EPS to jump to approximately $7. That's a big jump from the $6.23 they posted for 2025.
It is. So they're betting that volume comes back. And because they've cut costs so aggressively, that extra volume will turn into massive profit.
That's called operating leverage. They've slimmed down the factory and the workforce so much that if sales do come back, the profit flows straight to the bottom line. It's a coiled spring. But They aren't done cutting yet, are they? The outlook mentions more cost removal.
Another $150 million. They want another 100 basis points. That's 1% of margin expansion purely from efficiency.
So let's do the math. 2025 was $200 million in cuts. 2026 is another $150 million. That's $350 million of structural costs stripped out of the business in 24 months.
It's a total transformation. They're trying to become a company that can make money even if the economy is mediocre.
But can make a fortune if the economy actually booms.
It's a high-reward strategy, but it carries high risk. If the housing market doesn't recover, if interest rates stay high and people stay put in 2026, then Whirlpool has a problem.
They've cut the fat, but they need the calories. They need the revenue.
Their entire guidance for 2026 is predicated on Americans starting to move again.
So, bringing this all back to you, the listener, we started by saying this spreadsheet is a barometer for the American home. So what is the forecast telling us?
Whirlpool is betting that 2026 is the year the freeze thaws. They are seeing signals, or at least hoping for signals, that real estate is coming back.
But they're also telling us that inflation is sticky.
Oh, yeah. Tariffs are real, costs are up, and manufacturers are done eating those costs. They're going to pass them on to the consumer.
It's a fascinating picture. A lean, somewhat battered American giant. They've shed their global weight in India. They've written down the value of their grandpa's favorite brands. And they're just crouching in a defensive stance, waiting for the housing market to finally turn the corner.
And in the meantime, selling a hell of a lot of stand mixers to keep the lights on.
The stand mixer really is the MVP of this report. It's the little engine that could.
It really is.
Before we wrap up, I want to leave you with a thought to mull over. We talked about this huge bet on the housing market. Whirlpool has more data on home habits than almost anyone. They know when your fridge breaks. They know when you buy a suite of appliances for a new build.
They have their finger on the pulse better than almost any economist.
So here's the question. If a company with that much proprietary data is publicly betting its financial future on a 2026 real estate recovery, should we believe them? Should we get ready for a boom? Or is it possible they are forecasting a recovery simply because they have to? Because the alternative, admitting that 2026 will be another year of stagnation, is just too painful to put into a guidance report.
Are they seeing a sunrise?
Yeah.
Or are they just hoping for one because they can't survive another long night?
That is the multi-billion-dollar question, and the answer will determine whether their stock price doubles or crashes in the next 12 months.
Something to think about the next time you load the dishwasher.
Thanks for listening to The Deep Dive. We'll catch you on the next one.